Just 2 minutes to go here until the closing bell. We have Joe Fahmy. He's of Your Capital, managing director there. And we also have Reynolds, a chief investment officer with Los Angeles Capital, to help us break down the action that we saw today. But let's take a look at where things stand here in the final couple minutes of trading. We had the Dow off 266 points. It was off 382 points earlier today after we got the updated projection on inflation and also the potential timing of rate hikes. The dot plot spooked investors just a little bit, but after we heard from Fed Chair Jay Powell at the press conference, basically saying that the dot plot projection should be taken with a, quote, big grain of salt, and that the liftoff is, quote, well into the future. That helped ease some of the concern that we saw from investors here, Adam, and we're looking at the Dow now off just around 266 points.
You know, one of the things that Jay Powell said, too, because there's this concern about inflation, but he said in regards to that, it's a, quote, perfect storm of very strong demand and limited supply. And he used the example that Miles Udland wrote about on the Yahoo Finance platform about lumber prices. We saw lumber prices shoot up, but they are now coming down. And what the Fed is expecting, because there's no guarantee, but the Fed is expecting that what we're seeing with inflation, whether it be PCE or core PCE at 3% or more, they do expect that to be tempered in the next couple of months. But that's one of the things investors are trying to get ahead of. We saw the yield on the 10-year jump about 10 basis points from where it had been yesterday, and now it's at 1.56. So a lot of people wondering about this, Shauna.
They certainly are. Yep, we have the 10-year yield up just around 6 basis points right now. Again, the Dow worst performers today. We have Dow Inc., Walmart, and 3M.
And we have a closing bell. We're going to get the gavel in, and we can put all of it into the history books, along with the comments from Federal Reserve Chairman Jay Powell. He did have a lot of comments that moved markets today, but not enough to get us into the green. It looks as if we are going to settle down on the Dow, 264 points, S&P 500 off about 22 points, and the Nasdaq off about 33 points. Sectors that were in the green today, just one, consumer discretionary, up about 0.25%. Big drop for consumer staples, off 1.2%. And we also saw energy down about 0.5%. Let's go to our guests because there's a lot to deal with here. And Hal, let's start with you. What we saw with the increase in the 10-year, were the people who were selling bonds today overreacting?
I think probably not. What I found most interesting in the Fed's statement, sort of two things. A, they increased their inflation assumption to 3.4%. So that was a significant increase over where they'd been 3 months ago. And then they also confirmed something that we already know, which is they're not even really talking about raising short-term rates, and that the focus is going to continue to be on asset purchases. And so basically what you're telling the world is if you're in a money market fund, you're going to lose 3.5% this year. And, the yield curve is going to be very steep. So I like that for financials. That's going to help financials.
Joe, what did you think of what we heard from Powell when he was talking about how the dot plot, we need to take that with a grain of salt? It's too early to start thinking about this. Is it still too early when we have such strong data coming out month after month, and it really shows that the economy is starting to pick up steam?
Yeah, I feel like it's the same story in the last recent Fed meetings where everyone is very stressed out and they're worried about the tapering and they're worried about raising rates. But they've made it perfectly clear they're not raising rates anytime soon. And to the other guest's point, even if they taper, maybe they go from 120 billion down to 80 billion, it's still very accommodative. So I think there's way too much drama and stress about something that's going to happen in 2023. I haven't even planned dinner tonight, so I don't even know why there's this much drama about it when the overall environment is incredibly accommodative for equities and will remain that way till the end of the year.
Joe, the drama begins when you have the fight over who's doing the dishes. But here was the quote in regards to what you're saying. The real near-term discussion that will begin is the path of asset purchase reductions. That came after he said we should retire the term about talking about. So at some point, they're going to stop buying 40 billion worth of mortgage-backed securities and 80 billion worth of U.S. Treasuries. But that still appears to be, at least a year off?
Yeah, I think they won't start that until early 2022. But then aside from the tapering and the purchasing, the buying of securities, the bond buying is that the interest rates are still pretty much near zero, and there's no signs of that. I think they priced in from the dot plots 2 hikes in 2023. So even if they do taper, again, the interest rate picture is still very low, and they will telegraph everything. I think Powell has made it perfectly clear he would rather be late than be early and make sure everything from this pandemic has recovered fully.
I might just add to that. I agree with Joe. He'd rather be late than early. There's no doubt about it. He's fighting the last battle, which oftentimes is hard to avoid. But, I think we have to be a little careful not to be overconfident that we won't see tapering until 2022. Because one thing Chairman Powell does a good job of, he talks about the great difficulty of forecasting and all of the uncertainty surrounding it. So to me, he's living in the present. Clearly, he cares more about jobs and inflation. That's come through very clearly. But I think there's, they're going to react to data, as it comes in this year. I asked the question, how would today have turned out differently had rates not fallen 25 basis points? That's the 10-year Treasury. Had that not happened, and had not lumber prices and other commodities come down in a dramatic fashion in the last couple of weeks, how would that have changed today's discussion? And I don't know the answer to that. But I think the important thing to remember is they're living in the moment. They're looking at current data. It's clear what their goals are, and it's clear what tools they're going to employ going forward.
Yeah,
Jared, what do you make of the reaction? Go ahead.
Sorry, if I can add one more point. He's making a great point about, I'm not being complacent about it, because there will still be data points and CPI and so forth that can cause some volatility, over the next few months. So that's something that, investors do have to keep in mind.
Jared, let me get your thoughts real quick from the floor of the New York Stock Exchange. When you're just taking a look at the reaction that we saw in the broader market today, yes, we're in the red. We're well off the lows of the day. Is there a sense down there from the traders that this was a bit of an overreaction to what we got from the Fed?
Well, let's take stock of the reaction. The Dow finished the day not even 1% off. And I'll repeat my statement from earlier that it was telling that the 2 p.m. announcement got more volatility than the presser. I think when the dust settles here, what are we going to focus on tomorrow? We're still going to be talking about this, but we're in an earnings vacuum right now. The second half of June, one of the most seasonally weak periods of the year because it's summer, not a lot of news out. So I guess my question for you, Joe, because you write about this kind of thing, what are you seeing for stocks over in the short term, over the next few weeks until a month maybe when we get into the next earnings season?
Yeah, that's a great point, that we still have to get through the seasonality of the end of June, where usually takes a day or two for people to digest the Fed statement and the press conference. So we have to digest the Fed meeting from today. You also have to get through the Russell rebalancing, which the annual rebalancing takes place on June 25th. And then you have normal end of the quarter for some of the passive managers, normal portfolio adjustments that can lead to added volatility. But I think coming out of that, once we get through that seasonally weak time, now we can start to look forward to some of the fundamentals and the earnings season that's coming up. And then you might start to get a run up in anticipation of the next quarter of earnings releases.
Hal, you actually have written about this. At the beginning of the year, everyone was talking about time to get out of growth and go to value. Then it looked as if maybe that wasn't the play. And yet, in fact, you still believe it is the play, right?
We do. And we do in part for the reason that everyone states, and that's valuations. But also analyst sentiment continues to grow for value. It's sort of interesting. If you look at different economic regions around the world, analyst sentiment is better for value in every region except large caps in the US. And the only reason why it's still slightly better for growth is because of 10 names, the 10 mega cap stocks. If you equal weight the two indexes, Russell 1 growth and 1 value, analyst sentiment stronger for value. So anyway, we still like value. And for the reasons I talked about earlier, I think we're going to have a steep yield curve for some time to come. I think it's going to get steeper. I think rates will go up. There's no doubt in my mind the Fed has distorted absolute rates and also credit spreads through their actions and their statements this year. And the good news is we've got a robust economy, and let's hope that continues. But yeah, we still like the value side of things.
Joe, what do you like in this environment, and anything you heard from the Fed today that makes you change your strategy or your approach to some of these investments right now?
Being more of a growth manager, I like to gravitate towards the growth stocks, especially as the Nasdaq has been in a correction the past 4 months. the sectors that are either coming back quickly or have held up very well. And specifically, those three sectors are semiconductors, medical products, and software. We're noticing some names coming back. Of course, if the 10-year yield does rise and maybe gets back towards those pre-pandemic highs, 1.9, that would affect valuations. But for now, at around 1.5, I still think that it's a favorable environment for those growth sectors.
Jared, you got a final thought on this?
I'll tell you what, I think we might be on the verge of a trend change here. I'm really interested to see what the bond market does tomorrow, and especially that Russell rebalance on Friday. That's another kink in the markets, but usually that's not a market-moving event. I think it's going to be a quiet 2 weeks here, and we might see some more rotation, but I really want to see if that trend gets underway with bonds, and also the dollar shot up. If the dollar rises materially, that has huge implications for the overall markets.
All right, Jared Blickray, thanks so much. And of course, our thanks to Joe Fahmy and Hal Reynolds as well.